Hi everyone, welcome to today's podcast, which is all about 15 minutes on pensions and retirement, but especially for those who are high earners earning over 260,000. So I've got up the chat and the Q&A, so if you've got questions, just pop them in as we go. If they're relevant to what I'm talking about, I'll answer there and then, but if not, I'll stay later to make sure that I answer everything as well as we go. So a little bit about me. So I can see there's a few clients on here already, so welcome to you all. But my name's Lisa and I'm a chartered financial advisor and recently just passed the 𝗙𝗏 accreditation as well. And I've been doing this for many, many years. And I think the most important thing for you is that I'm a fellow of the Personal Finance Society, which only a handful, couple of % of financial advisors actually have that qualification. So the most important thing today is that it's not advice on this call. I just want to bring up some things that are on our clients' minds when they're earning over 260 and the way that we plan their finances. Now, 95% of our clients, when they first come on board, have never ever had financial advice before. So if you're new to us and you're a bit nervous about getting in touch, then please don't be. We're all geared up to help people who have never had financial advice before in the past. And we have different levels of clients. So we start off with a financial diagnosis session. That's someone who just wants an hour of our time, and we'll go through their financial plan and show them their shortfalls and what they have to do every year, all the way through to wealth clients who've got over £1 million with us. They're having regular reviews and we're proactively managing their money for them as well. So the £260,000 problem is what I'm calling this. And it's hard to accept, but the more you earn, sometimes the less progress you can make, especially when it comes to retirement planning. And we see it especially at the end of the tax year. It's a really busy time for us because people get in touch because they're unexpectedly pushed over into this earnings bracket from bonuses or RSUs, and they haven't planned for it. So the most important thing, and the reason why we're doing this session now, is so that everybody can get that little bit ahead and be planned for the end of the tax year. Tax is obviously a bit harder at this level, so you're well into the 45% tax threshold, but because you're earning over 260, there's not a lot that you can do about that when it comes to pension planning. You can't control your earnings bracket just by doing pension planning alone. Pension planning is also restricted to those who are earning 260 or more, and I'm going to talk you through that. If you worry that you've got a problem, do get in touch. We've got a lovely lady here called 𝗙𝗏, who is obsessed with pension carry forward calculations, so she can help anyone who needs any help there. I'd say the common trap for people who are high earners is often they can get swept away knowing and feeling comfortable that they are earning really, really well. But when they first come to us, at least, I think they're lacking a really deliberate plan of they know what they have to do every year to stay on track. And the mini takeaway from this little slide is really just make sure you really understand your limits, how much you can pay into a pension. And if you're married or in a civil partnership, really understanding your partner's limits as well can mean that you can actually attack this as a couple and be more efficient as a couple as well. But obviously as clients, those of you who are clients on the call, we do all that for you naturally anyway. So a high income, I know this is obvious, but a high income doesn't automatically mean a high retirement income anymore. Gone are the days of those final salary pension schemes where those two things were linked. Now we're obviously responsible for building up our own pensions, but because exceptionally high earners can't pay that much into a pension, you need to be really thinking about all the other things that you can build up to help supplement that retirement. So I'm just going to do a quick poll, which will really help me to understand what bracket everybody's in. So hopefully you can see it. If you can't, just tell me in the chat, because this is actually the first poll that I've ever done by myself. Oh yeah, I can see it's working. So the first question is, do you know the value of your pension? So we're not trying to catch you out, but some people love to log in and really understand what they're worth before they even got out of bed. Some people, it's when the statement arrives, and some people never look at it. And we even have clients now who only ever look at it because we force them to. So we're definitely not judging you. And then the last one is, do you know the age at which you could stop work and what you can spend per annum? So that's either yes, I've got a rough idea, or the answer's no. So I'll give it one quick second, because I think there's a couple of you that haven't filled it in, but if you'd like to, don't feel obliged. And let me press end now. So amazingly, it was really split between the do you know to the nearest thousand and you know a rough idea, but it might be a bit out of date. And then what age could you stop working and what you've got. So most people either don't know or have a rough idea. So by the end of today, I want to make sure that you know how you can work it out and you can feel confident on these things. Okay, so I think these are the three questions, and I tell you why I love doing this job is more often than not, when we do those FD sessions, the financial diagnosis sessions, it can get really emotional, because actually people have more choice about how they shape their career than they realise. So don't be shy if you do want to have fun. So what is the annual allowance? So there's more on the annual allowance on our YouTube channel, so you can watch other videos that I've made. But just to quickly run through it, most people, unless they're earning over 260,000, you're allowed to put £60,000 a year into your pension, or 100% of your earnings. So if I was earning 40,000, I could put 40,000 in and get full tax relief. I could put more in, but I'm not going to get that tax relief. And the great thing about pension carry forward is, as long as you've had a pension at any one time, you can go back to the last 3 tax years and use unused allowances. So if you're newly in this 260 bracket and above, this is what you need to work out. And we'll obviously monitor it on an ongoing basis for clients. But currently, what you would do is you'd fill the current tax year. So assuming you're not a high earner, you could do 60,000. And then you'd go back and you'd fill the 23-24 tax year, and then the 24-25 and the 25-26 in that order. If you don't use these 2 tax years, these 2 can still be carried forward to the following tax years. So in this current tax year, it's really important that if you've got any allowance left in this year and the previous 2023-24 tax year, that they're used up, because if you don't use this one, it will completely be gone. And as I said, the most important thing is that you've had a pension at some stage. So a client who did really well in his business but hadn't really been doing pension planning, we were able to use this method and go back for the last 3 tax years, because when he did his very first graduate job in his 20s, he happened to be in that pension for a couple of months. And so that allowed us the permission to go back. If you've never had a pension, then you can only do the 1 year that we're currently in. So for those of you on the call earning over 260, this is how the rule goes. So for every £1 you earn over 260,000, you can put 50p less into your pension. So I've done a little table to show you. So 260,000 of earnings, you can pay 60,000 in. If you're earning 40,000 more, so 300,000, you're allowed then to put £20,000 less. So you'd be allowed a £40,000 limit. 20, and then when you get to 360 and above, it's just capped at 10,000. And this isn't just 10,000 from you, this is 10,000 from the employer, from you, and also from the tax relief as well that goes in. So really make sure that you're tracking this. We do see people fall foul of these rules, not quite every week, but definitely monthly when they're new people. Also, it's important to say, if you have breached the rules, there's something called scheme pay rules, which means if you get yourself organised and on time, you can get the pension to pay the fine for you, rather than you having to pay that fine personally, which just softens the blow, because obviously pensions have come from taxable, tax-free money. So the most important thing is to find your number. And whether you're earning this much in your 20s, or whether you're earning this much in your 5 minutes from retirement, it's really important to understand what exactly is the target. And that's why we really go through people's goals, to really understand them, because one person's target sounds like hell to another person. So it's understanding the retirement age, the way you work up to retirement, how you might spend during different periods of your retirement, and also what your lifestyle goals and gifting goals are. If you haven't seen it, again, on our YouTube, we've got a webinar with 𝗙𝗲, who is a psychologist, which is how to retire well, because we see time and time again clients financially prepared to retire, but perhaps not mentally ready to retire. And it causes all sorts of problems when you opt in and opt out of retirement. It's helpful if you can have this predictable way and sort of path into retirement. The next thing, I think, for especially high earners, and I see this all the time, especially if people have got a sales element to their role, or it's a very, very stressful job, they may be allowed to keep working in their role, but do they want to keep working, I think, is the most important thing. Could they really, really keep going at the rate that they're going? And sometimes I find with clients that if we plan a retirement where they can go part-time, or they can take a complete career shift at some stage, usually in their 50s, then psychologically it does change their mindset, which means I'm working because I'm choosing to, rather than because I have to. So really getting to know your numbers can psychologically help you, at least for going that little bit longer in the high-paying jobs if they're very stressful. It's really important to know if your plan would still work if you had a bad year just as you retired. So we've had a record amount of clients retire in the last 12 months. And fortunately, on the whole, it's been a very good investing year. But if you had a stock market crash just before you retired, it brings into something called sequencing risk. And this means that if you having to take money and become a forced seller, so you're taking money out while it's low, it can impact the amount of time that your money will last for by many, many, many years. So it's really important that you plan 3 to 5 years before retirement to make sure you've got hold of this sequencing risk. And that's the same for part-time as well. If you're going to need your investments to top you up, it's really important 3 to 5 years before that you're getting a handle on this, to make sure that you're accruing assets in the right order, so it's not too risky. This is the most scary thing. I feel mean actually even saying this, but how many paydays do you have left until you want to retire? Retirement can feel a really, really long way away, but I think that question can really bring it to the forefront of your mind. I think, actually, I haven't got many paydays to sort this problem out if you've got a shortfall. So if you've got 10 years left, that's still only 120 paydays to have a really, really big impact on your retirement. And then lastly, your retirement really, really should be focused on you and your dreams and your desired lifestyle. I love it when people come to us with the most weird and wonderful things. Last week I had someone who wanted a forest, and I remembered from our exams there's specific tax rules for forests. So I had to go and look them up. But I do love when people come to us with the weird and wonderful, because it makes it really, really interesting for us to plan people's retirements in that way. These are the risks that I see trip people up. Bad timing, as I mentioned before, the sequencing risk. I'd say this is one of the biggest threats, especially a very big overlooked threat to people's financial planning. Next one is inflation risk. We all know that inflation can fluctuate and has been high in the past, very recent past, but often the things that we spend money on in early retirement travel, healthcare, and obviously later on in life care tend to increase above inflation. So you might need in your plan to have higher levels of inflation just to stress test your plan to make sure that what you're aiming for is realistic. There's also something called spending drift, which is if you're used to earning loads, it means it can be very, very hard to change your outlook when you come down to retiring. So I think we get used to a lot of discretionary spending. And so it'd be good to work out, A, what could you cut back on if you want to cut back on, but how would you really do that in real life? A sad one, but midlife health curveballs, and we see this far too often. Someone gets poorly, it means that they can't do their job anymore, or maybe they need a year or 2 years out. But it's most important that you're protected. So have you got income protection at the right level? Is it enough for your current salary? Is it just on your base salary but doesn't take into account the bonuses that you rely on? Do you have critical illness cover? And sadly, if anything were to happen to you, do you have life cover? So make sure if you're employed, you're getting these through your company, but if you're, and then topping up if you need to. And if you're got your own company, you can actually set these up often coming out of your business as a business expense, so it can be very tax efficient, and we can help you with that if you need to. And then one that we're seeing a lot at the moment is this sort of career risk, reinvention, redundancy. A lot of high earners may suffer from burnout and need a complete shift in career in their 40s, 50s, 60s, whenever it may be. So we just need to be prepared for things like this as much as you possibly can be. I just got a quick question which says, how do you practically sort out maxing out the pension contributions from the previous 3 years? Is the onus on you to keep records and sort it out? That's a great point, actually. So you do need to prove it, and the HMRC may ask for your records as well. I've never known a client be asked for their records, but obviously we keep them for clients just to make sure that we're proving what money went in. So we're going to keep pension contribution statements. We're going to keep pay slips as well to make sure that we can see what somebody's earning, to prove their what their annual allowance actually is in that year. Tax returns are also important to keep on record, and then you're to keep these records for 7 years as well. We keep them indefinitely unless the client wants us to get rid of them, just in case. So here's a checklist I thought of for high earners. So first of all, do you know your limits? Have you worked that out? And also, do you know your partner's limits too? So maybe your partner isn't earning as much, maybe they're earning a lot more. But knowing each other's limits means, as I said earlier, you can really work this out as a team. Have you got the right mix of savings? So especially if someone is a very high earner from a young age, they're not going to be able to max out their pensions very aggressively, if at all, actually, only up to that £10,000 allowance. So you need to build up other things. So whether you're a high earner or not, having ISAs in retirement are amazing, because money coming out of pensions is taxable, money in ISAs is tax-free, and having those two things can really help us minimize someone's tax as they go along into retirement. Also, having general investment accounts, they're subject to capital gains tax, have a capital gains tax allowance, so that adds more to the mix. And some clients will have onshore or offshore bonds, which are taxed very differently as well. So having a different mix of assets that we build up over time can really help us as the government inevitably changes the rules throughout your retirement and how things are taxed. Do you have a concentration risk? We see this all the time, especially with clients who get big shareholdings in their companies, most commonly in tech and banking, I suppose, are the sectors where we see that the most. But if you can, it's really important to sell down and to distribute those shareholdings into your overall portfolio and diversify them. I was an advisor when Lehman Brothers went down, and we had lots of Lehman Brothers, so they were losing their job, their shares at work, and obviously bonuses that hadn't already paid out. So having money spread around would really have helped them with hindsight. Are you wasting any workplace benefits? It's a real balancing act, because let's say your employer matches your pension contributions, but by accepting those matches, you breach the annual allowance. We need to just help you with those calculations to make sure that if you're breaching the annual allowance still after tax, you're better off. It's also good to look into the small print of your work. A lot of employees will allow you to receive the money you would have had in pensions received personally in your monthly paycheck. And if that's the case, we just squirrel that away from clients and put that into their ISAs, general investment accounts, as if it was their pension planning as well. Are my investments suitable for my time horizon? So I've got a lady whose retirement I'm planning now. She's in her 60s, but her children are still at school. And so we're planning on her retiring actually in her late 60s. But her workplace pension is all geared up to her retiring very soon. So these investments almost cash-like. And so we need to switch those and make sure the default funds aren't working against her. And then have a really good think about what that 3 to 5 year time horizon would look like. And would you change? Would you go back to would you go down to part-time and then gradually retire? Or are you just going to retire? And if so, what will you spend? Because that will really help the advisor work out what assets should be where and taking which risk. And then on our website, you can download something called the Legacy Pack. And that really helps you to answer the what happens if I die scenario. So yeah, for free of charge on our website is our Legacy Pack. We just got a question which says, are there any tips on working out how much you need to retire? No idea where to start on this. So you can go online and find pension companies have got rough modelling tips on how to project forward what you have and what you need, which have also done some research into what average people in retirement need, whether they want a luxury or a standard lifestyle, whether you're single or in a couple, which I think can be really helpful. Fidelity have also got a calculator called the Power of Small Changes, which I love, and that just shows you what if I just did 1% more. And then the big sell for me is that we have the solution as well for clients, which is one of those financial diagnosis sessions as well. And I'll show you how they work at the end. Okay. And I've just put this here to remind you how income tax works. And so to think, I know everybody on this call is earning over 260, but if your partner is earning less, you can see which tax bracket they are falling into. And if so, can we use that to make sure we're boosting the tax relief you're getting as a couple? So this is the second mean part of the call, which is close to 50% of people in the UK over 40 won't have saved enough for a comfortable retirement. So that's not a luxury retirement, that's a comfortable retirement. And that is 1 week European holiday per year, which may or may not fit in with the lifestyle that you planned. So it's really important that you find out which 50% you're in. And to the lady who had the question about how we work this out, this is how we work it out with clients. So this is a real life example. A client wanted to retire at 60. So the bottom graph down here is showing her working till 60 and then us spending her savings, investments. This along the bottom is the state pension. But if she just kept doing what she's doing and didn't change anything, she'd have a retirement shortfall from the age of her being 76 and her partner being 82. So this is what we needed to do. So to solve her problem, it's real life. So that's why you've got the grayed out bits. She'd save another 130,000 a year, get a 6.4% return a year every year, or reduce her spending expectation to £77,000 a year in retirement. or get a lovely lump sum of 1.6 million. So knowing those parameters can really help. Obviously, this doesn't feel like too high a growth rate to try to achieve for this lady. She does get big bonuses, so she probably can afford to do this, but not every year. Depends how work goes. And this to her didn't actually seem that scary, reducing her outgoings to 77,000 a year. So we just then stress tested it that little bit further and said, well, what if she went till 55? This is a lady with a really, really stressful job. And so we went that little bit further, so what if she retired at 55? That brings a shortfall down to her being 66, which meant she'd need to save 300,000 a year. That was just out of the question. That was too much for her. It meant we needed 8.2% return, which, whilst she's had that because she's reasonably high risk right now, I was worried that she perhaps wouldn't have that same appetite for risk later on when she's, say, 80, 90 years old. So we felt this was a bit too much, but she did think she could reduce her spending down to just shy of £5,000 a month. And in the end, the compromise, which there always is that she felt, well, probably she'd quit this stressful job at 55, work in something that just paid her outgoings until 60, and then fully retire at 60. So we ended up making a really well-informed compromise for her. And then just a reminder, so the financial diagnosis session is the one that I just showed you. Accelerator clients are those at the beginning of their careers who have assets less than 250. We get everything set up for them, but we don't charge ongoing advice. And then clients, as they get to over 500,000, can go into the core higher net worth or wealth levels of clients that we look after. So the most important thing would be to find out what's your biggest takeaway, what are you going to do after this session to make the time worthwhile. Sorry I overran, that was a huge amount to fit into just 15 minutes, but yeah, have a session to think about what will you do next with the information that you now know to improve your financial situation. How we can help, so we're really big on making sure that everyone can benefit from our knowledge, not just clients. So you can follow us on Instagram. We do fortnightly newsletters, and obviously if we can help, do let us know. Financial diagnosis session costs £500, and if you pay for that, then that stays on the account and is deductible against future financial advice as well. And that was all. So thank you, everyone. Oh, someone's asking, will there be a recording? Yes, there'll be a recording that we sent round to everyone who signed up. So that will go out. And we're just working in the background for a download for our higher earners download pack, which is going to include this webinar, a budget planner, a net worth tracker, the pension carry forward spreadsheet that we use for clients. So thank you so much for coming along, and if there's any more questions I'll stay on, but if not I'll press end. Lovely. Well, thank you everyone.